Well, good morning, everyone, and welcome to this webinar hosted by the dealership and private client groups of Forvis Mazars around how to prepare for the upcoming sunset of the estate and gift tax exemption. My name is Buddy Dearman, and I'm the national industry leader of our dealerships practice. I'm based out of Memphis and am delighted to be joined today by Tara Thomas, tax partner in our Nashville office, who leads our dealership tax efforts, Troy Farmer, a managing director and wealth strategist with our private client group out of Indianapolis, Will Muschin, a director in our Birmingham office, who leads our dealership valuation efforts. As a national industry leader for our dealerships practice at Forvis Mazars, I have the pleasure of working alongside more than 200 of the most talented individuals who share our passion of serving over 4,000 auto, commercial truck, machinery and equipment, and recreational dealerships across the country. We feel that today's topic is especially important and timely, as it seems that the pace of inquiries we are receiving around valuations and related planning has really gathered steam over the last few months, and it really appears to show no signs of letting up. So how about we jump into today's material, and I'll turn things over to Troy Farmer.
Good morning, everyone. Appreciate you joining us today to talk about the 2025 estate and gift tax exemption sunset. I wanted to step back for a second and talk a little bit about exactly what the estate and gift taxes are. We're hearing a lot about the sunset, but sometimes we have to step back and say, wait a minute, what are we really truly talking about? The estate and gift tax system in the United States is a transfer tax system. It is a unified system where the estate tax is assessed at an individual's death on all the property that they own at that time. The gift tax is a tax on property transferred during lifetime. Now, your estate is very, very broadly defined in the Internal Revenue Code. It's any property that you own. That could be cash, that could be investment assets, that can be life insurance, that is your qualified retirement plans, that is your business. And if you are certain trusts, if they meet requirements, could also be force or cause inclusion into your taxable estate. Certain trusts that are structured another way would not. But the point is, the word estate in the estate and gift tax code is very, very broad, and it's worldwide assets. It is not just U.S. assets. So the tax brackets for the two are integrated. And what that means is that there is a progressive tax rate on gifts and estate, just like there are individual income taxes. And as your estate and gifts get higher, the rate goes up and it tops out. And this is the amount that is assessed on most estates at 40%. And when I talk about the integration of that gift and estate tax, it is unified in that the exemptions available to be used for the transfer tax system are the same and share the same amounts, whether you give away property during your lifetime or wait and give it away at your death. So very broadly, think of the gift and estate tax as a unified tax on what you own and may transfer to other individuals or institutions or charities at your death or during your life. So with that, there are certain things, exclusions, tools, etc., to keep in mind that can lessen the impact of that tax. And first of all, many of you probably have already heard of this, is the annual exclusion amount. And the annual exclusion amount right now is $18,000 per year. It's annual. What that means is any person out here in the audience could give $18,000 to any other person that they want, and there are no tax ramifications to that gift. So I could give Buddy Dearman $18,000. It does not affect my gift and estate tax ramifications whatsoever. It doesn't affect anything on Buddy's end. It is not income to him. It's $18,000 free and clear for all parties. If you are a married couple, obviously with the two of you, you could give $36,000 a year to any individual. So, and remember too, with that 40% tax rate, every $18,000 you give away could save $7,200 or more in estate taxes at your death. This is a very, very popular tool. Many of you out there probably already use this, but it is what I call the frontline defense to the gift and estate tax, an annual exclusion gifting program where you might give, if you are married, $36,000 to each one of your children every year during your lifetime, via an outright gift or a gift in trust for that individual. And we have eliminated that $36,000 from your taxable estate with no tax ramifications to anyone. Now, if you give them more than that $36,000 in any one year, you will start to use up some of that exemption that we're going to talk about. But the first $18,000 is free and clear. And what's not on here, just to keep in mind too, if you pay medical expenses on behalf of any person directly to the doctor, hospital, medical institution, those don't count at all. They could be as much as $100,000, $200,000. But if you pay it directly on their behalf to the institution, that doesn't count as a gift. Same thing for tuition, but keep in mind that if you're paying the tuition, you can't give your child or your niece or your nephew the money to pay the tuition. You have to pay the tuition directly to the educational institution. But if that is the way the gift is structured, it is outside the gift and estate tax exemption. So those are some frontline defenses, I call them, to the gift and estate tax system. In addition, there is an unlimited marital deduction. So any individual can give as much to their spouse as they would like at life or at death, no tax assessed at that time. Keep in mind, however, that if your spouse is not a U.S. citizen, that amount can be limited every year. But if it is gifts between U.S. citizens who are married, there are no transfer tax ramifications. Gifts to charity. Gifts to charity, obviously, during your lifetime qualify you for a charitable deduction on your income tax purposes. Excuse me. Gifts to charity are not taxable gifts for the gift and estate transfer tax system. And gifts to charity at death are dollar for dollar reduction of that estate tax base for assessing any estate tax liability. So gifts to charity are obviously very, very tax efficient, both for the income tax system and the transfer tax system. And finally, what we're going to spend most of our time talking about today is this lifetime annual exclusion. And it is lifetime, but it's also death time, if you want to put it that way. Every individual in the audience today, right now, has an exemption from the unified gift and estate tax system of $13.61 million. So any one of you out there could give $13.6 million to one of your children, split it between 3 or 4 children, and there would be no transfer tax on that gift. Now remember, if you use it up during your lifetime, you don't have it at death. But if you don't use it all up in your lifetime, you do have what's remaining available to you at death. That goes back to the integration of the gift and estate tax. The advantage of using this exemption during your lifetime, if you can and so choose to do that, is once you gift those assets away, any appreciation on those assets from the date of gift to the date of your death is also removed from the estate tax base and would not be owed estate taxes at that time. So utilizing that exemption during lifetime becomes a very, very important part of an estate plan for any person. So today we're going to focus on how and why this is important to think about right now, and then other ways you might want to consider using it, keeping in mind the succession plan for your dealership. So that's sort of the background of the estate tax and how it came to be and what we're dealing with, and then this exemption amount, which is going to be the focus of the rest of our presentation. So we have a polling question. Do you have an exit plan in place that is integrated with your estate plan? And this polling question is actually an early preview of what we're going to be talking about for the rest of the hour, in that your estate plan is one item. That's, your wills, your trust, how your estate's going to flow. Your business succession plan is another item. What will happen to my business? Am I going to sell my business? Is that my exit plan? Do I plan to sell to management? Do I want my kids to take over? Whatever that succession plan is a separate plan, but those two plans affect each other very much and need to be integrated. So this polling question is a little bit of a preview of things we're going to get to.
Troy, and I think we need the audience to click on one of the choices.
Yes, sorry about that.
CPE credit and all of those other.
I'm sorry, you are absolutely right. Oh, there we go.
Yeah.
We got some results.
I have no idea. Troy, I thought it was interesting. On your previous slide, I was going to say something, and you said it well. The use it or defer it. I mean, the sooner you use your exemption, the more opportunity you have for appreciation to build outside of your estate for your, those who you're intending to benefit in the future. And the other consideration is that you may find yourself in the situation we're in right now, where the exemption changes and you had an opportunity to transfer some assets, and by virtue of law, that opportunity doesn't exist anymore. So
and I like the way you phrase that, buddy, as an opportunity, because we are going to examine here in a few minutes what I call that opportunity cost of not taking advantage of these exemptions, why they are at this level. For sure. So 20% of you already are following along with me and ahead of the games with your exit plan and estate plan integrated. Some of you, the rest of this webinar should be very relevant for you to get going on that process. So let's go talk a little bit about that exclusion. This is just some information on how the exclusion has changed over the years. Now, I'm going to be honest with you. I started my practice years before 2011, when this gift and estate tax exclusion was only $675,000. I remember when it went to $1 million and everybody thought that was great. That was a big jump. Well, in 2011, with tax law changes, it was codified on a permanent basis at $5,000. I'm sorry, $5 million, adjusted for inflation each year. So you can see since 2011, the inflation adjustments that have gone up every year until we get to 2018. 2018, we see this big jump in the exemption amount where it basically doubled. In 2018 is when Congress in the Trump administration passed the Tax Cuts and Jobs Act, where the exemption was taken from $5 million a person to $10 million a person, adjusted for inflation over time. So that took it from 5 million to the 11.18. And then we see our inflation adjustments every year to 2024, where we're up to 13.6. You'll notice in 23 and 24, the jumps were a little more significant. Inflation was higher in those years, and that resulted in more exemption being available. We expect another jump from 24 to 25. It has not been announced what that is yet, but we do expect another jump at the beginning of 2025. So again, like I said, Congress passed the Tax Cut and Jobs Act, which basically doubled that exemption. So we're going from, at the time, 5.5 million to 11.1 million. And that's for an individual. So remember to always double that for a married couple. And so it significantly reduced the number of US citizens subject to the estate tax. And we are now up to a point with those exemptions where in 2024, this year, an individual can give away 13.61 million, there's that number again, and so 27.22 million for couples with no consequences in the gift and estate transfer tax system. So when you think back to those tools and exclusions and defenses I was talking about, that $18,000 a year also gets adjusted for inflation. We may see an increase in that next year. It usually goes up in $1,000 increments. But that $18,000 per person per year, no matter how many people you want to give $18,000 to, is available to you to do every year. This exemption amount is really a use it or lose it proposition. Using it while it's available to you and using it during your lifetime is usually much more tax efficient because we're going back to, hey, we're moving all the appreciation on these assets off my taxable estate balance sheet as well. So when we are doing estate planning, part of the process is looking at a client's balance sheet to help them determine what are the highest appreciating assets that I would get most bang for the buck for moving off my balance sheet during lifetime using my exemption, rather than waiting till at death to transfer those assets. So right now, again, we have these very high amount of exemptions. But here's what happens in the Tax Cuts and Jobs Act. Those exemptions at this doubled amount are expiring on December 31, 2025. And on January 1, 2026, we expect those federal estate and gift tax exemptions to revert back to the 2018 levels adjusted for inflation, which means we are expecting the individual exemption to drop to 7 million, 14 million for a married couple. A very significant drop in what you could pass outside of the estate tax system and gift tax system versus doing some of these gifting right now. So everybody's like, is it really going to happen? Are they really going to let it drop back down? Well, this is Troy Farmer's opinion here. This is not anyone's, I'm not endorsing on anyone's behalf. This is my observations. In order for something to happen to prevent this sunset, Congress has to take action. It is codified into law. To change that law, it will take an act of Congress to change that. I think we all have been observing in Washington how hard it is to get anything done. So we have to remember that this will take some proactive steps by Congress to prevent this from happening at December 31, 2025. So I think there is a, yes, go ahead.
Yeah, I was going to say, I was going to say, this is crystal ball time.
Yes,
I hate to put you on the spot, but really, I mean, out and about in the professional community and talking with clients, you hear people say, "Oh, they won't let it sunset." Well, they don't have to do anything, and it sunsets, right? So
Correct.
it's not like they have to let it sunset. It sunsets automatically. So then, I've heard some professionals say, we've never had a decrease in the estate exemption. It's always gone up, except for the time that went away to nothing, and there was no estate tax. But you have any sense whether this is a popular item for them to do something proactively with?
Well, so we've got a lot. You're right. It's crystal ball time. No one has the exact answer. But I think we can factor in a few things. One, again, it's going to take action for it. Congress is going to have to pass a bill to keep it from happening. And we see how hard it is to get bills through Congress.
Yeah.
We have an election coming up in November 2024. It obviously, whichever parties control Congress and the presidency in getting this through, it probably will vary by which party wins and controls Congress, controls the presidency. My personal opinion is it could very well go down because of the conflict in Congress in getting anything done. I don't see it going up. I don't think it will get increased simply because of two things. One, frankly, government needs the revenue. Two, there are Senate rules in place that if you enact tax cuts, in order for those tax cuts to be permanent, there has to be corresponding, so you're making a cut to revenue, tax revenue. There has to be coordinating or qualifying permanent spending cuts in other areas. So if you're going to reduce my revenue on a permanent basis, United States, you have to enact spending cuts of that amount in order to balance things out. It's called the Byrd Rule in the Senate. The Byrd Rule takes a 60-vote majority to get things passed. Frankly, I don't see either party in November winning 60 seats in Congress. So I think the most likely scenario is if it doesn't drop, if they do something to keep it from going down, they will enact another sunset to keep it at the same levels it had. That's why we have a sunset, is because of this Byrd Rule. Okay, you can do this for 10 years, but it has to stop because you didn't enact corresponding spending cuts. I think what very well could happen is, okay, it's at this level and we're going to keep it there for another 10 years and we'll kick the can down the road.
I got you. Yeah.
That's Troy Farmer's, observations. I'm sure there are other people out there that probably think, nope, no way, they'll do something. That's my observation. I think there's a very good chance it could go down. I do not think it will go up. So if it goes back to that point of, if you are in a position where you should really be thinking about using these exemptions, you should go ahead and be thinking about it now for that very key point of the sooner you move it off your taxable balance sheet, the more appreciation you're moving off over time. Does that answer your question? Make sense?
Absolutely. And hey, it may be a tad bit early because you might be getting to it a little bit later, but there was a question from the audience about does a gift during lifetime receive the same basis step up? We hear about basis step up at death, right? Mm-hmm. Does gifts during lifetime have the same stepped up basis that they would at death?
Very good question, and thank you for asking it, whoever that was. They do not. And that is very much a factor in consideration in designing the estate plan and what assets should be used for gifts versus what assets should be allowed to remain in the estate. Because the very easy way to put this is, if I have stock that is worth $10 a share, but my basis is in it as $1 per share, I transfer that stock to somebody, they turn around and sell it, their basis is $1, so they've got a $9 capital gain. If I wait and bequeath them that stock in my will, and it is worth $10 on the date of my death, they get it, turn around and sell it, they will have no capital gain because they got to step up in basis at death, and their basis now becomes $10. So in in a well-executed estate plan, you are looking at the assets on the balance sheet as to which makes sense to give away because we know we've got all this appreciation coming in, but they may have a lower basis versus I've got an asset that the basis is so low, it would make more sense for me to hold on to it and leave it as part of my taxable estate. So there's a fine line balance that you have to, juggle when you're looking at an estate plan on what assets to give away and what assets to keep. So let's talk about using this 13.6. It may go up a little bit next year while it's available. This is what I call what Buddy referred to earlier, sort of the opportunity cost. So if you looked at a couple that had a $50 million net worth with their business, their residences, and their investment assets, all their other property, their total taxable estate of the couple is $50 million. If that couple said, okay, I can afford to give away $27.22 million, I'm going to do it. And in 2024, they had used their exemption, their taxable estate is reduced to 22.78. They owe $9.1 million in estate taxes. Take that exact same scenario without any appreciation on assets, and that exemption is halved. The tax owed goes up to 14.556. So what we're calling is the opportunity cost of not evaluating using this exemption while it's available is about $5.4 million going to the government that could be saved going to your family. So we're honing this in as a $5.4 million opportunity cost, and let's be looking at it so that we can be as tax efficient as possible. So how do we do this? How do we do putting together a plan that will save me $5.4 million in taxes, but keeps me where I want to be during my lifetime? When we're talking about giving away that much in assets, it's a very significant gift. It can, if someone came to me and said, hey, I need you to give away $13.6 million. Well, okay, I get it. I should give away $13.6 million to save $5.4 million in estate tax, but what about me and the rest of my life? So what we're trying to do here is minimize those taxes to maximize the inheritance for the next generation. But we also have to craft this estate plan or wealth strategy plan, and it really will be three parts. A plan for the passage of the business and your other assets, making sure the documents to do all this are in place, and then, I know a lot of people that, went through the process of setting up trusts and whatever, and then those trusts never get funded. So we did all this work and it had no effect. So a big part of wealth strategy is not only designing the plan, it's making sure that it gets implemented and executed. So what my group within Forbes Mazars Private Client does is help you develop that plan, implement it, and execute on it. And I should talk a little more while we're right here about private client. So Forbes Mazars Private Client is a industry group within Forbes Mazars that is dedicated to helping individuals. It has three pillars within private client. We have consultative tax, which is tax planning, tax return preparation, all related to consultative tax. We have wealth management. We do have a wealth management arm that helps invest assets. And we have what we call family office services, which is helping our high net worth families set up a family office, do the outsourced accounting for the family office, helping, again, wealth strategy for the family office. So my group, which falls within that family office and consultative tax, helps clients put together these wealth strategy plans to say, hey, I think I need to use my exemption, or hey, help me figure out if I need to use my exemption, and then put together a plan that's an efficient use of that exemption through lifetime gifts. And we can do everything from giving you ideas and discussing what those tools are, to integrating a whole plan that includes your business succession plan and making sure things are integrated. And we do that using modeling and visual analysis, forecasts and presentations to show you, hey, here's my financial situation today. Here's my financial situation if nothing changes in 2026 and the exemptions drop. Project that out to a mortality age of, we usually use 90 or 95, but then show you, hey, here's some things you should think about doing to maybe use this exemption today to benefit your family. And then if you did that, okay, here's what your situation now looks like today, where your cash flow is, what your tax liabilities look like, what your projected estate tax savings are. It is a very holistic approach, is what I would like to say. But we can help you become very better informed in making decisions on how much to give away. So we do have another polling question. Have you connected your CPA with your legal and wealth advisory teams? We'll give everybody a minute to answer the question. But this is also a preview of a point we're going to make in a little bit. It is very important that all of your advisors are aware of your wealth strategy and what you are trying to accomplish, so that your CPA, attorney, wealth advisor doesn't do something on their side that the other advisors don't know is happening that might throw a wrench in your wealth strategy. So it is very important, the phrase, it takes a village, gets overused a lot, but in some cases it's very much true that in executing a wealth strategy plan, all of these advisors need to be on the same page.
Troy, I would add one other person or one other group of individuals that need to be in the loop, especially for those on the call who are involved in the dealership business, and that is your OEM. So the manufacturer generally has some say-so in permitted owners, who you can transfer ownership to, what kinds of trust, et cetera, et cetera. And the sooner you get them involved in the process, the better. I remember a number of years ago when there was an impending change to the estate tax system. Many of the OEMs had reached their capacity as far as being able to approve ownership changes. And they were saying, if you don't have your paperwork to us within 3 months of the end of the year, we're not guaranteeing that we'll be able to get it done for you. So I think it's important when you're thinking about the landscape of who needs to be, I mean, you don't need to bring them in at the very beginning, but at a certain point, you got to make sure they're on board with the proposed structure and those kinds of things. Just wanted to make that point.
Yes, that's absolutely true. In this industry, that definitely has to be taken into account in your timeline. And I have learned that working hard with Buddy on a couple of succession planning, estate planning clients that we have going on right now. They're trying to work out how they might want to transition their business and use these exemptions, and it is of vital importance, because you can have your whole plan and then you can't get the approval. It could blow everything up. So thank you for making that point. Mm-hmm. So if I get too far, no, here we go. Okay. So let's talk a little bit more about integrating that business exit or succession plan with your estate plan. So, there's a lot of considerations here. First and foremost, you do have to think about what is my exit strategy? You know, do I want my family to inherit and own this business? Do I think I have key management that might want to buy my company? Maybe an ESOP where the employees end up owning the company. Or do I think my exit plan is I will sell to a third party or to private equity? Well, if you need help making that decision, we need to be running forecast projections and analysis on what each one might do to your personal situation to make you feel more comfortable in helping you determine what your exit strategy might be. But regardless of the exit strategy, you have to keep in mind, and sometimes I think in talking about estate planning and ownership succession, ownership exit, especially in succession, you have to remember that your management succession plan needs to be considered as well. You may want your family to inherit your business, but your family may have no desire to run the business. Sure, they'd like to own it, but they may not want to run it. Well, how do you make sure that that business stays the viable, very successful business entity it is today? You have to have a management succession plan in place. So that point there is just don't forget that needs to be incorporated in as well. This is one of the things that I think is most important in developing a wealth strategy. The first thing that you should do and what your advisor should do with you is determine and quantify a live on capital number. So in other words, hey, here's how I live today. Here's what my cash flow is. Here's what I'd like to do in the future when I retire or when I sell my business. These are expenses I expect to have. I want to increase my vacation travel. I might want to buy another residence. You know, my business, which is absorbing some of my expenses, is no longer absorbing those expenses because I don't own it anymore. What is the number I need to live the way I want to live? So let's determine that so we know what our base is, and from there can say, okay, well then we can afford to give this much away or this asset away. If someone is trying to help you with your estate plan, and I like to call it a wealth transfer plan, but if they're helping you with that in your business succession plan and there is no conversation about your live on capital to start, I think you're missing a key point. You know, frankly, if you want to sell your business, you might want to know what you need to get for that business to live the way you want to live. So I think it often gets overlooked. I'm a former practicing trust and estates attorney. You know, before I came over to Forvis to help this, you know, develop this wealth strategy department, I don't remember thinking much about that when I was an estate planning attorney. Not that they're not thinking about it, but they don't have the ways and the software and the accountant mind to quantify it like we can on the CPA side of the aisle. Again, it takes a team of advisors. And then to a point we talked about earlier with the basis, et cetera, the strategies need to be in place to minimize both income taxes and estate taxes. And that line between the two needs to be considered. So finally, if we've determined that live on capital, we know we need to use some of this exemption, then how do we do it? Well, how you do it is you gift typically to family members via various vehicles that estate planners and wealth planners have in the toolkit. You know, but most and very many of those are trusts. There are different kinds of trusts out there. What trust you use would be dependent upon your goals. But related to that, when you start to give ownership away, Tara's going to talk about some considerations there that you also need to think about.
Thanks, Troy. A couple things that I wanted to mention here, something that you just touched on is it's really important. If you take away anything from this slide, it's that you need to consider both the income tax implication and the estate tax implication here, as Troy just mentioned. So, something that's easy to forget is that once you make a gift, there's lots of things that change after the fact. So your income allocations, again, I'm talking about a gift of dealership stock ownership in your operating entity. When you have new owners coming in, whether those are individuals or trust, those new owners are going to have K1s. They might now have quarterly estimated payments that they're not used to remitting. So there can be a change in the flow of process and just making sure everyone understands how that income is going to be reported and where that tax liability is going to sit following a gift is just a crucial consideration to add into developing this plan. Along those same lines, and this might be more important, especially for the dealers, is once you make a gift of, again, I'm talking about S corps or partnerships, units or stock, your cash flow in the form of distributions is going to change, and it's going to have to stay pro rata with that new ownership. So for the dealer that previously owned 100% of the entity and was used to taking cash from that entity whenever they needed for tax payments or anything else, when they make those distributions now, they need to be considerate of the fact that a pro rata distribution is going to have to be made to the minority partners in that entity. And that can be a really difficult shift sometimes for folks who are used to having it kind of one way, especially if you're going from 100% to less than 100%. One of the things that Troy mentioned was the use of trust. Grantor trust can be a very effective tool in estate planning, but cash flow is really impacted there because you might have a situation where the dealer, who is the grantor, might still be paying 100% of the tax on the income that's being generated by that entity. But the distributions, as I mentioned, are not going 100%. They might be going 75-25. So now that dealer who's picking up all of the income has to find other cash to pay the tax on the income that's allocated to the grantor trust, because the distributions that go to the trust ideally should stay in the trust. Now, some trusts could have provisions that would allow distributions to be made from the trust to the grantor to cover taxes. But typically the strategy for using a grantor trust is dual in that it's moving assets out of the estate to grow, and that appreciation is out of the estate. But separately, you're trying to whittle down the other assets that individual taxpayer may have by them, again, having to pay the tax on both their share of the income as well as the grantor trust's share of the income. So again, cash flow is greatly impacted. Troy just mentioned it. As far as what is that live on capital, if you're going to use grantor trust, this consideration is really vital to make sure there is enough cash flow that will be generated to cover kind of the new lay of the land with the new ownership structure following the gift. And just a couple other quick notes here that I'll mention. We focused a lot on gifting of maybe dealership stock or partnership units in a dealership entity. Obviously, many of our dealers also have other entities and other assets that could be gifted in their estate plan. Real estate is something else that we've seen certain clients consider. You might not get as much bang for your buck in a valuation standpoint there if you're gifting real estate, but that's also a good consideration. From, again, a cash flow perspective, if you're used to getting all of that rent, but you're gifting interest in a real estate entity, obviously you'd have to be mindful of some of that cash flow changing post-gift. Just another effective tool, again, if you're not ready to, I think maybe I froze. Hopefully I'm back.
Yeah, you are.
Okay. Again, that can just be another effective strategy in assessing your overall plan. But I will go ahead and kick things over to Will, who will talk through the valuation aspect of these items.
Thanks, Tara. So on the valuation considerations, I think if gifting is an item that you're considering, the gift that ultimately go on your gift tax return, there'll be a number that goes on there for a variety of purposes. And so you want to make sure the valuation here is done under the definition of fair market value. So the definition of fair market value is different than investment value. So fair market value is for a hypothetical willing buyer and a willing seller, whereas investment value, IRS's adequate disclosure requirements. And that's very important because if it's not adequately disclosed, then the statute of limitations does not begin. So once adequate disclosure occurs, the IRS typically has 3 years to audit that gift. And so if that's done, the statute of limitations is 3 years. But if that's not done or doesn't meet all those requirements, then that statute of limitations does not begin, and therefore you could have kind of indefinite time exposure there. So it's very important that you have both a qualified appraisal as well as meeting those adequate disclosure requirements. As part of the qualified appraisal, it's also defined that a qualified appraiser needs to be performing that analysis. Part of being a qualified appraiser is defined that you have experience valuing similar businesses. So it's important that you're not using not only a business appraiser who has business valuation credentials, but also someone with experience valuing dealerships. So there's typically 3 valuation approaches that are considered. One would be an asset approach, the other would be an income approach, and the third being a market approach. One nuance to dealerships is that there's a market approach that is highly utilized in the industry that we often refer to as the current industry market indicator method. It's also commonly referred to as the blue sky methodology. So it's important that the appraiser is familiar with that methodology, which involves valuing both the blue sky or the intangible assets of the dealership, along with all the other assets that the dealership operating company owns.
Hey, Will, I hate to interrupt you. I think we are having some technical difficulties. I don't know if it's everyone, but before we're going to continue with the presentation, but we need to do the third polling question so those folks can get their CPE. So we're going to advance the polling question right now so that folks can at least do that, especially if they have to drop or if the technology is giving them trouble. So the question is, have you made any transfers in ownership to family or existing management? Yes, no, or no, but we plan to by the end of 2025. Yeah, Will, I've had some folks text me that said they lost it on their side. I also have had some people in our office who are not on the webinar that have said they seem to be interrupted. And we're in 4 different offices, so I don't know if this is like, I don't know if it's the Russians or, we're being hacked or.
Well, hopefully everybody can get it back and we can finish up.
Yeah.
But interesting. So about 70% have not yet made ownership transfers yet. So I think in kind of wrapping up the valuation considerations piece before kicking it back over to Troy, I think that understanding kind of the valuation methodology that's used, that the blue sky multiple methodology is very commonly used in the dealership industry. And so the 2 key assumptions that really go into driving the blue sky value are the normalized level of earnings and the market multiple that are applied to those earnings. So the past 5 years have certainly been a very interesting time in our industry, going from, call it, a normalized level of earnings in 2019 to supply chain issues, which increased profitability for many dealerships in 2021 and 2022, to kind of decreasing profitability since then in 2023 and into 2024. So understanding what's a normalized level of earnings that an owner would expect going forward is very important in that process. And then the other component I mentioned is the blue sky multiple. So the franchise is obviously a very, very important part to that multiple. But there are also a number of other factors, such as, if a new point is being added nearby, that's often going to take the multiple down. And then the market you're in, it has a high relevance to that multiple. So high growth states with low taxes, such as Florida, for instance, may push that multiple up. Valuation discounts and premiums. So, if you're transferring a controlling interest in your dealership, that might warrant a control premium. But oftentimes dealers want to maintain control, and so they're looking at gifting minority ownership interest. And so various valuation discounts may be applicable to get that from that controlling level of value down to a non-controlling level of value. So for instance, discounts for lack of control, discounts for lack of marketability, since this isn't a share of stock that's trading right now, A marketability discount could be applicable. And if the ownership interest is a non-voting interest, additional discounts could be considered for that as well. And as Terry was talking about, other dealership-related entities such as dealership real estate holding companies, these discounts can be applicable to real estate holding companies or other entities as well. And then finally, what's the process look like if you're going to get an appraisal done? So typically, the appraiser would send you their document request. Typically, the key items there are the past 5 years of financial statements. So often requesting your manufacturer financial statements, tax returns, any other financials that are available, along with ownership agreements, such as operating agreements, which might outline specifics to those ownership interests. That gets the appraiser started. After they get that information set up in their analysis, they'll typically have an interview with management to make sure they understand specifics to that dealership, such as the management team, changes to the competitive landscape, et cetera. And then from there, the appraiser would issue their draft analysis and report, and ultimately that qualified appraisal, which would go along with the gift tax return. So those are some of the high-level points as far as what the valuation process will look like. So I'll kick it back over to Troy as far as how we can help.
Thanks, Will. Appreciate that. And just to reiterate, Tara, preparing the other family members for what these changes may mean if they become owners, and then, another critical part to deciding how much to give away and what assets to give away is that valuation, which will have to be substantiated with the IRS. So getting that valuation up front is also another critical step. I know we're getting a little close on time, so just a couple of quick points here. The other thing with your business succession plan and your estate plan, your wealth transfer plan, is we want to make sure that we're considering asset liquidity, that if there is any tax liability due at death, that we have a plan to cover that tax payment so that we're not forcing any fire sales of assets to raise cash. Life insurance can be a big part of your wealth transfer plan. And by that, I mean not only life insurance to help cover liquidity at death for estate taxes, but life insurance for the business to cover key employees, et cetera, that we might want to make sure are sticking around in that management succession plan. And then again, I'm going back to that village, but professional guidance and making sure all of your advisors are on the same page and helping you cross the T's and dot the I's on this plan to make sure that it's all in place is vitally important. And, we want to help you do that. To sum up, we've talked about a lot of things going on, and we're talking about a 2025 sunset. So, that's 16, 17 months away. Why are you guys telling me, get on it, get on it, get on it? The question is, we need to do a lot here. We need to get advisors in place. We need to develop the recommendations that you might want to consider for transfer planning. You want to have some time to think about those. You want to get the OEM and dealer franchisors approval if we are going to propose ownership changes. And then we got to, execute the plan with the legal documents, et cetera. We have around our footprint heard attorneys starting to say that if you are not engaged with them by the end of 2024, they won't guarantee your work can be done by the end of 2025 when the sunset starts. So that's why we're, really advising, don't wait. Start now. Let's get those recommendations to, put together so that you can consider what you want to do, get the advisors in place to help get that plan executed so that we're not at the last minute in 2025 trying to get things done and trust funded and somehow or another you miss the limit and the exemptions do go back down. So the other thing, just to sum this all up, this is a timeline that we think you should really be looking at if you're considering using those exemptions. If you're even unsure whether or not you need to use that exemption, we can help you figure that out. Reach out to your Forvis Mazars advisor, and they will put you in touch with me or the right person to help you get that figured out. But once that wealth strategy and plan is done, once we get that put together, you're not done. Those things have to be continually reviewed periodically. Goals may change, tax laws may change. So keep in mind that it is a fluid plan that will be revised over time. So, Buddy, I will kick it back to you if you have any closing remarks.
Yeah, well, we're gonna launch the poll, but we'll ask you to go ahead and answer the polling questions about whether you'd like to be contacted to discuss today's topics further. We did have a couple of questions that came through. First of all, appreciate everybody being on the webinar today, and apologies for some technical difficulties. It sounded like it was more widespread than just maybe one of the presenters or whatever. But there were a couple of questions, and they came in at the last here toward the end. One was about a valuation of a dealership that is tied to a very old buy-sell agreement that has a fixed formula, and we've seen those for years and years and years about either transfers to management or things like that. And those formulas, the IRS likes for everything to be done at fair market value, and those formulas may or may not comport with current fair market value. And so if it's something where you're going to have to make a disclosure on either a gift tax return or a state tax return, then an old buy-sell is probably not adequate, and it's probably not going to be considered adequate disclosure as far as the IRS is concerned, and you're probably going to need a professional current valuation that takes into account all the things that would be determinative of current fair market value. I don't know if that got the question that you were specifically asking. Any other questions we didn't get to, we get a record of those and we'll get back to everyone. We also will make sure that those of you who were with us and weren't able to, I saw a couple of people weren't able to answer a polling question. So we'll work with our CPE folks to make sure that folks get the appropriate CPE. Again, we appreciate everyone joining us today, and hope that you all have a great rest of your day. Thank you.